This lecture is all about long-term contracts. So we've already discussed consignment inventory, which is a different way of recognizing revenue. And when we talked about consignment, we saw that we weren't able to recognize any revenues and expenses until such time as that notification message was sent out. The next type of revenue recognition that we need to discuss that's a little bit different, or actually quite a bit different than what you're used to, is long-term contracts. So with long-term contracts, the reason they even exist is because there's certain projects that take more than one accounting cycle to complete. So it's not like walking into Walmart and buying a sweater and all criteria of the earnings approach for revenue recognition have been met, and Walmart can just recognize the sale and everything's done. There are certain projects that take an extended period of time to complete. And I've given you a few examples on the slide. So things like shipbuilding, high-rise buildings, custom software projects. It could be us designing or developing and building a luxury resort. Okay, so any of those types of projects typically take longer than 1 year. So what we need to be able to do is have an accounting methodology that allows us to track revenues and expenses over a period of time. And there's different rules as to when we recognize revenue and expenses between two methods or two models, which we'll discuss in this chapter. One thing that you need to know about these types of contracts is that they typically provide for what's called progress billings. Okay, and if you think about this logically, imagine that we were doing a $25 million high-rise project. Okay, so someone had contracted us out to build a $25 million high-rise for them. That's quite a lot of money, cash flow that we would have to come up with to help finance the project. So what progress billings allow us to do is send out invoices to the customer and have them help fund the project. The second benefit of progress billings is that it reduces your risk on the project. So imagine we were doing a $25 million high-rise project, and we get done the project and we contact the customer and we say, hey, we're all done. And they say, oh yeah, well, we don't have the money to pay you, sorry, right? So what do? You can sue them, you're going to try and go after them, or you're going to try and look for a new buyer. But either way, at that point, you're $25 million out of pocket and you're kind of in trouble. So progress billings reduce your risk by collecting in some of the payment throughout the course of the project, so that when you get to the end of the project, it's just a smaller portion left that the customer still has to pay to complete the contract. So there's two methods, like I said, that are available to help us measure revenue. And there's some similarities. So the good news is, as we learn the completed contract method, which is what we're going to do in this lecture, as we learn the completed contract method, there's going to be some carryover into the percentage of completion. Okay? So the way the completed contract method works, essentially, we wait till the entire job's done. We don't recognize any revenues or expenses on our income statement. So there's no gross profit recognized until such time as the entire job is done. So in the final year, we're going to recognize 100% of the revenues and 100% of the expenses. Okay? During the course of the project, though, if we can't recognize revenues and expenses, we have to have somewhere to put all of those costs, right? And you'll see as we work through this that any major contract, any major project that's in process is called WIP. It's work in process or project in progress, okay? And it's an inventory item. It's essentially a partially finished good that at some point we will sell down the road, but right now it's inventory and we're still working on it, okay? You'll learn more about WIP inventory in your cost accounting courses and when we talk about inventory later in the semester. So that's the way completed contract works. We basically we wait till the very end of the project and then we recognize 100% of the revenues and 100% of the expenses. Okay. The second method has some similarities, but it's also different. One of the ways, or the main way it's different, is that under percentage of completion, we don't wait till the very end of the project to recognize all of our revenues and expenses. What we try and do is incrementally throughout the project, so each year, we try and recognize a little bit of the profit or a little bit of the revenues and expenses based on what percentage of the job we have done. And this semester, when we talk about percentage of completion, we're going to focus on calculating our percentage of completion using the costs incurred versus the total estimated cost of the project. We'll talk more about that in the next video. But those are the two methods. Completed contract, we wait till the very end, recognize all our revenues and expenses, and percentage of completion, we recognize a little bit of revenue and expense every single year. So the question is, why not wait? Completed contract is the easier method to manage. Okay, it's much simpler and less involved than the percentage of completion, but why wouldn't we wait? Well, one of the key things is relevance, right? Imagine you're doing a 3-year project and you wait till the very last year to put all of your revenues and all of your expenses on your books. For the first couple of years, it's going to look like you're doing absolutely nothing. And your statement readers are going to have an issue or are going to have trouble understanding how you're moving along in the course of this project and how close you are to completion, and really truly how much revenue you've earned already based on how much of the job you have done. So one of the reasons we wouldn't want to wait and we'd want to use the percentage of completion is that it provides more relevant statements, right? And again, our statements may not reflect our economic activity during the period. Basically, what have we been up to, right? If we wait to the very end under completed contract, what have we been up to? So is it an option? Can we choose? And the answer is no. If we can, and we'll talk about this in a later part of one of the videos, if we can estimate the percentage of completion, we have to use percentage of completion. It's not an option, okay? So if we know how much cost we've incurred to date, if we can estimate how much cost there is to complete, and if we know the total contract value, then we have to use percentage of completion. It's our guideline, okay? And it makes a lot more sense for our financial statement readers. It makes a lot more sense for them, for us, to use the percentage of completion. But let's talk about completed contract. Like I said, revenues and expenses and profit are only recognized when the project is 100% complete. So what we have to talk about now is, what do I do with all those revenues and what do I do with all those expenses for the first couple of years or the first year while I'm working on this project before I can recognize it on my income statement, right? What do I do with those billings that I send out to the customer? Because typically when I send a customer an invoice, it's revenue, right? And what do I do with all those expenses that I'm paying? So when I buy materials, when I pay subcontractors, when I pay for labor, when I pay for all these different costs of the project, if I can't put them on my income statement as an expense, what do I do with them? Okay? Well, the answer is, for our expenses that we've incurred during the year, right? So the second bullet point here, our expenses that we've incurred during the year, they're posted to an account called Project in Progress, or you can call it Work in Progress, okay? I like to refer to it as the PIP account, P-I-P, right? Project in Progress. And that's how I'll probably refer to it in these videos. So our incurred costs go to the PIP account, right? And that PIP account, that Project in Progress account, is an inventory account on the balance sheet, okay? It's not on the income statement. It's not a liability. It's an inventory item on our balance sheet, okay? So you've got this new account. This is one of the new accounts you guys are going to need to know for this chapter. So all of the costs that we pay, and the question will tell you what the costs incurred for the year were. The question's probably not going to go into extreme detail as far as we paid this much for labor, we paid this much for materials, we paid this much for subcontractors. What it's probably going to say is the costs incurred for the year were $10 million. Give me the journal entry, okay? So all of those costs incurred, we're actually, instead of debiting an expense, we're going to debit our PIP inventory account, okay? On the flip side, when we send out an invoice, like I said before, we can't recognize that as revenue because this completed contract method doesn't allow us to recognize revenue until the job is done. So where do we put it? I know when I send out an invoice, it's very simple. I can debit account receivable, but if I can't credit revenue, what do I credit? Well, your second new account, if you look at the third bullet point here, your second new account is called Billings on Contract, right? Or Progress Billings, whichever you prefer. Again, I have a short form. I call it BOC, B-O-C, for Billings on Contract, okay? So when I send out an invoice, I don't credit it to revenue. I'm going to credit it to my BOC account, right? And that BOC account, the Billings on Contract, is contra to your PIP account, right? So we put all of our expenses in the Project in Progress, the PIP account, and it's an inventory item. So under inventory, you would have something called PIP, right? And then below it, right below it, you would have something that said less Billings on Contract, or less BOC, PIP minus BOC. BOC is a contra account to your PIP. What that means is it works the same way as accounts receivable and allowance for doubtful accounts. On our statements, we show accounts receivable less allowance for doubtful accounts to get to net receivables. Is that right? Well, when we deal with this PIP account, when we deal with this long-term contract account, the PIP account is an inventory and Billings on Contract is a contra to it. So we show PIP less Billings on Contract, and that's the net work in process, or the net value of the project. Effectively, have we invested more in the project than the client has or the customer has? Okay? So again, costs, they don't go to the income statement, they get debited to the PIP account. All of our invoices get credited to the BOC account. And then at completion, when we're finally done the project, what we get to do is we get to close out and recognize 100% of the gross profit. Okay, so there's an extra entry that's required in the final year to recognize revenues and expenses and put that gross profit on our income statement. So that's effectively how it works. Now let's take a second. Let's take a second to take a look at the journal entries. Okay? Sorry. So under the completed contract method, there are 3 journal entries that you will do every year no matter what. Okay? So if I ask you, or a question your homework asks you, or a question on the test asks you, give me all required journal entries for a given year, whether it's year 1, year 2, or year 3, there are 3 entries you will do no matter what. And remember at the beginning of this lecture I said that there's similarities between completed contract and percentage of completion. Well, this is the similarity. These 3 entries that you see on the overhead right now, the costs incurred, the interim billings, and the payments received, whether you're doing completed contract or percentage of completion, and whether it's the first year, the second year, the final year of the project, no matter what, you will always do these 3 entries. So you need to nail these 3, because on the test or in a homework question, if it says, give me all required journal entries for the year, those should be your first 3 entries, and you'll be right every single time. The debits and the credits are identical every single time. The only thing that changes is the amount from year to year, okay? So these journal entries are your first 3. So your standard 3 entries that you need to record every year. You need to record the costs that were incurred on the project for the year, right? So that first entry records your costs incurred, and it goes to your PIP account, like I said. So your journal entry is a debit, and right here I say construction project in progress. That's really your PIP account, PIP. And I'm okay if you use the short form. So we're going to debit our PIP account, and we're going to credit cash or accounts payable. It depends on how we paid. So again, I'm fine with cash, I'm fine with accounts payable, or cash/accounts payable like I've got here. Okay? So my costs incurred for the year, that's the first entry I make every year no matter what. How much did I pay for the project or invest in the project? I'm going to put that to my PIP account. The second entry we make every year is how much did we invoice the client, the customer, right? Those interim billings we talked about that help us fund the project. We get to send them out invoices based on a schedule that's typically identified in the contract, okay, based on a percentage of completion. We get to send them invoices that say, hey, we need you to pay, you know, this amount of money to help fund the project. We're this much of the way through the project. So the journal entry to record that is to debit accounts receivable, right? That's pretty standard. Anytime we send out an invoice, we're going to debit accounts receivable. But again, under the revenue recognition model of completed contract, we can't recognize revenue until the job is done. So instead of crediting revenue here, we're going to credit billings on project, or billings on contract, or progress billings. Anything of that variation is totally fine with me. This is what I call my BOC account, billings on contract. Okay? So when we invoice them, we debit AR and credit BOC. The third entry that we make no matter what is our payments received on progress billings. So we've invoiced the customer, right? In bullet point 2 there, we've sent out an invoice to the customer saying, hey, you owe us some money. They're obviously going to pay us. So when they pay us, we record that the same way we record any other payment on account. There's nothing different. So even if this was just someone paying on a normal accounts receivable, the journal entry is a debit to cash and a credit to AR. Okay? There's nothing tricky there. So those are our 3 entries every year no matter what. We're going to record our expenses, record what we billed the client, and record what they paid us. Get that mantra in your head. Record our expenses, record what we billed the client, record what they paid us. Those are the 3 entries you make every year no matter what. Okay? So we do that every year, and that's whether it's the first year, the second year, or even the final year of the contract. But once we get to the final year of the contract and the project is now done, what this methodology says is, hey, now you can recognize some of those expenses, or you can recognize those revenues and expenses. Okay? So we have 2 closing entries that we need to do when the job is finally done. And these closing entries are our revenue recognition entries. This is when we actually get to recognize that revenue. Okay? So the first entry is to recognize revenue. And where have we been putting it all along? We've been putting it in our billings on contract, that BOC account. Remember, in the previous slide, when we were sending out the invoices, we were debiting AR, and instead of crediting revenue, we were crediting BOC. So once the job's done, what I get to do is I get to clear out this billings on contract account by debiting it, and I get to credit my revenue from long-term contract. Or you can call it construction revenue if that's more comfortable for you. But effectively, this is our revenue recognition here. We debit BOC and we credit revenue from long-term contract, or credit construction revenue. Okay? But that's not it, right? We've only got one side of the income statement effectively entered now. We've got the revenues, but we're missing the expenses. And if you think back to those first 3 journal entries, when we were recording our expenses, our costs incurred for the period, we weren't debiting expenses and crediting cash or cash/AP. What we were doing is we were debiting our PIP account and crediting cash/AP. So now that the project's done, we need to clear all of those expenses out of the PIP account, and we need to post them to our expenses. So the journal entry for that is to debit your cost of construction and to credit your construction project in progress. Okay? By doing so, the project is now done. So by doing these 2 entries, what we've done is we've removed all traces of the project off our balance sheet, right? In the second entry, we closed out our PIP account. In the first entry, we closed out our BOC. So now there's nothing left on our balance sheet, which is what we want, because when the job's done and we hand over the keys to the high-rise or to the ship, it's no longer our inventory because we've sold it. So we've gotten rid of all traces of this stuff off our balance sheet, and we've also recognized our revenue and expense. So we've effectively gotten our gross profit onto our income statement. Okay? So that's the way the completed contract method works. Let's take a quick look at an example, and I know I don't do this in every slide deck, but I wanted to do it for this one. So let's take a look at it. I made up a quick example. This is posted on FOL for you. We've got a long-term contract, completed contract. I just made a couple of notes to remind you. So long-term contracts exist because certain projects take more than a year. Under the completed contract method, no revenues, expenses, or profit is recognized until the contract is fully completed. Our costs get accumulated in a PIP account, and our billings get accumulated in a billings in progress, or billings on contract, our BOC account. Okay? So here's our example. Aloha Cabanas. I'm just going to lock this down. Aloha Cabanas has been contracted to build 30 luxury villas on a beach resort. Aloha uses the completed contract method of revenue recognition, and the project is expected to take 2 years. In year 1, Aloha incurs project costs of $13.75 million. The customer is billed for a total of $12,500,000 and pays $12 million. Okay? So pretend you've gotten something like this, and your instructions, or your required, says provide all necessary journal entries for the first year. Okay? And if you think, remember what we talked about for completed contract. There are 3 entries we do every year no matter what, and then in the final year there's an extra set of entries to recognize our revenues and expenses. Well, this is the first year, this isn't the final year, so we're not going to do that revenue recognition entry, but what we do have to do is do those 3 standard entries, the ones we do every year no matter what. The first is to record the costs that we incurred during the year. Okay, and in this case, we incurred $13.75 million worth of costs. So the journal entry to record that is a debit, and again, remember, we can't recognize revenues and expenses right now. So we're going to debit our construction project in progress, and this is effectively our PIP account, project in progress, and we're going to credit our cash or accounts payable accounts. Okay? So to record the costs incurred, we debit PIP and we credit cash or AP. Okay? The second entry that we do every year, no matter what, is to recognize how much we invoice the customer. And in this year, we invoiced the customer $12.5 million. So what's the journal entry to record that? Okay. Well, the journal entry to record that, well, if you think about it, anytime we send out an invoice, the debit is always the same, right? We're always going to debit that accounts receivable account. If we're sending out an invoice, it's going to be sitting in our receivables. So we debit AR. Okay. The credit, on the other hand, is one that we have to think about, because we know under this methodology we can't recognize revenues and expenses each individual year. We have to wait till the very end. So what's the credit go to? It can't go to revenue, so it goes to that other new account we discussed, which is our billings on contract. And again, not BOC. Billings on contract, BOC, is that second new account. Okay, so you debit AR and you credit BOC. So we've done 2 of the 3 entries that we need to every year. We've recorded our expenses, we've recorded what we've billed the customer. The third and final thing we do every year is common sense. When we invoice someone, typically they pay us. So we need to record those cash receipts. So if you notice, it says during year 1, they paid $12 million. So we were paid $12 million from the customer for the invoices that we sent out. So they didn't pay us the full 12.5 that we sent them out, or that we invoiced them, but they did pay $12 million. And again, this cash receipt is recorded the same way any other cash receipt is recorded. We're going to debit cash and we're going to credit AR. Okay? So that recognizes how much the customer has paid us. All right? So the other thing that you need to understand is what does this look like on the balance sheet? And there's 3 accounts that I want you to be able to identify for me, or identify the balances for me on the test or throughout the course of this chapter. You need to be able to tell me what's in AR, what's in your PIP account, and what's in your BOC account, and where do they go on the balance sheet. The first one's fairly simple, right? The first one, under current assets, we're going to have our accounts receivable, right? And if you think, look back to the journal entries that we just did. We invoiced them for $12.5 million. So we debited AR for $12.5 million. And then they paid us $12 million of that. So we're going to subtract, we credited AR for the amount they paid us. Well, if we invoiced them $12.5 million, they paid us $12, that means there's $500,000 sitting in accounts receivable. So you need to be able to show me that balance. You need to be able to critically think through it. A lot of times T accounts help with this. Okay. The other 2 accounts that you need to worry about for me are your PIP and your BOC. And remember, I told you that these are inventory accounts. So under my inventory, I'm going to start with my project in progress account. Okay. And if you think back to what we've discussed, the amounts that go into project in progress under this method are the costs incurred during the year. Okay. And we did a journal entry up here to record $13.75 million in costs. So my PIP account is sitting at $13.75 million. Okay? I also mentioned that the BOC account, that Billings on contract, is a contra account to your PIP. Okay? So under your inventory, you're going to show me PIP, and then you're going to show me less Billings on contract. And again, if you wanted to, you could use the short form. So our PIP account less our Billings on contract, okay? And we invoiced the customer for $12.5 million, okay? So go back to your journal entries. The second entry we made was to record the invoices we sent out. We debited AR and we credited BOC for $12.5 million. So that's what's currently sitting in our BOC account. $13.75 million minus the $12.5 million means our net project, right? That net project is sitting at $1.25 million. And that would be your balance sheet presentation, okay? So I could ask you to give me the journal entries. I could ask you to show me the balance sheet presentation. I could also ask you this question here. What shows up on the income statement at the end of year 1, right? We know revenues and expenses belong on the income statement. It's a temporary account. We also know that under the completed contract method, I can't recognize any revenues and expenses until the job is done. At the end of year 1, this job wasn't done, so the answer is really simple. There's nothing on the income statement for this project because under the completed contract method, unless the job is complete, I can't recognize my revenues and expenses. All right? So that's the first year entry. Now let's take a look. This is a 2-year project. Okay, this is a 2-year project. Now let's take a look at year 2 so that we can take a look at those closing entries. Okay, so in year 2, Aloha Cabanas completes the project. An additional $8.25 million in costs were incurred during the year. The customers billed $13 million during the year, and they paid $12. Okay, so they haven't paid us for everything, which typically isn't normal, but we'll run with it for this example. Okay, so again, this is the final year of the project, so we're finally going to be able to recognize our revenues and expenses. But again, before we do that, every year, no matter what, we're going to do the same 3 entries. And those 3 entries record our costs incurred, they record our invoices or our progress billings to the client, and they record how much the client paid us every year, no matter what. So let's get that done. Okay? In the second year, we spent $8.25 million in costs. So again, I can't put that to my expenses yet. So I'm going to debit my PIP account, and I'm going to credit cash or AP. Right? Again, this can be PIP. Okay? So I debit PIP, and I credit cash / AP, or just cash or just AP. I'm fine with either. Okay? So we debit PIP, credit cash, AP. We've recorded our expenses, our costs incurred. Second thing we record every year, no matter what, how much did we bill the client? And it says that we billed them $13 million. Okay, so anytime I send out an invoice, I know I'm going to debit AR. So I'm going to debit the AR for $13 million. The second thing, or the credit, however, can't go to revenues yet because we know we have to do these standard 3 entries. The credit goes to my BOC account, Billings on Contract. Okay, for $13 million. The third and final entry that we do every year, no matter what, is to record how much the customer paid us. And this question says that the customer paid us $12 million before the end of the year. So we're going to, we're going to debit cash and credit AR for the full $12 million that they paid us. Okay, so right away you should already be able to see and tell if I asked you to do the balance sheet presentation, AR is going to have a closing balance in it. Okay, because they haven't paid us enough yet. But there's your 3 standard entries. We record the costs that we incurred, we record the invoices that we sent out, and we record the cash receipts. Okay? Now that the project is done, though, and this could happen in the second year, it could be the third year, the fourth year, it depends on how long the project takes, we actually get to do the entries to recognize revenue. Okay, so now that the project's completed, we get to close out our billings on contract to revenue, and we get to close out our construction project in progress, or our PIP account, to expenses. Okay? So in the first year, if you go back up and look at your journal entries, in the first year, sorry, I just have to unfreeze that. Okay, let's scroll back up. In the first year, we put $12.5 million worth of billings in the BOC account. Okay? In the second year, we posted another $13 million to the billings on contract. Okay, so $12.5 million in year 1. We invoiced them $13 million in year 2. That means that the total amount sitting in our billings on contract account is $25.5 million. I get to close that out of my billings account by debiting it and crediting it to my construction revenue, right, or revenue from long-term contract. So that's one part of my closing entries, right? This is the extra piece in the final year under this method. We close out billings to revenue. The second step is that we close out our PIP account to the expenses, okay? And we know that all along, our PIP account has been where we've been posting our expenses. So in the first year, we put $13.75 million to the expense account, right? To the PIP account, sorry. And in the second year, we posted another $8.25 million. So if you add those two things up, you'll realize that we've debited the PIP account for a total of $22 million. So to close it out, we get to credit the PIP account for $22 million. Okay? And we close out the PIP to our construction expenses, or cost of construction. So in doing these 2 entries, what we've effectively done is we've entered these 2 figures to clear the amounts off our balance sheet, which put them here as our revenues and expenses, and therefore our gross profit is on our income statement. And that's all there is to the completed contract method. 3 entries every year, no matter what, and in the final year, we close out our billings on contract and our PIP account to revenues and expenses.